We think of private equity in the context of our unlisted mandates team, so it's a little broader than just private equity. It's private equity real estate as well, but it's roughly about $1 billion of commitments. In terms of geographical mix, historically there has been quite a lot of investment in New Zealand, but that's predominantly due to real estate, to be honest. So if you think more broadly, it's roughly about 75% offshore. If you're just talking pure private equity, 25% onshore. So the fund of funds side was probably our first and second investment, and then we started moving into, then we took on an advisor relationship in roughly 2009, and that's when we started making investments into commingled funds. And at that point in 2009 we were looking to build a diversified portfolio of private equity managers. So again, that's the classic style of vintage diversification, manager diversification, heavy emphasis on manager skill. And then in 2011 we implemented what we call our investment framework, which is a much more opportunistic way of investing, and that's where when we no longer have a target allocation to private equity as an asset class. We think of private equity as a way to access underlying investment opportunities. So it makes us a little different in that, you know, in one year we may not be making any private equity investments, in another year we might be making a lot. I think that's probably going to change a little bit over time as well. So at the moment our portfolio has an interesting mix of, you know, the big, large, diverse managers who have incredible breadth and variety in terms of their offering. But we also have an interesting mix of highly specialised, you know, French expansion capital, Scandinavian real estate, etc., etc. So that's how it stands right now. I think if I look to the future, increasingly we will be using private equity managers where we don't have in-house capability. So I would expect there to be more emphasis on private equity managers for our non-Australasian investment. But again, it depends on what investment opportunities come down our research pipeline, so it's a little hard to predict. And certainly the other big change I think that will occur with our portfolio is we sort of track through the years, we'll be making much bigger but fewer investments. So historically our average check size was sort of 28-30 million Kiwi dollars. Because we had some very small early investments, but I think, you know, in the future we wouldn't be looking to do anything less than about $100 million US for a private equity manager. So we have three managers in the Asian region right now, emerging Asia. So we have real estate exposure in China, real estate exposure in India, which is around development and of residential real estate, and we also have a more generalist Asia fund. So in terms of selection risk, they have been challenging manager selections, I think it's fair to say, because as a government funded entity we have very, very strict responsible investment and ESG criteria, and so that has made the emerging markets more challenging. But I think, you know, we're lucky we've got some great manager partners, and we've worked very closely with them to ensure that our ESG requirements are baked into those investment models. But emerging markets is a very big investment theme for us, and that's an area we continue to be really focused on. I think with co-investment, if you're talking about co-investment with managers, you know, we're realistic about what our capacity is there. I mean, we're a team geographically isolated in New Zealand, and we're not an enormous team. So we have done one co-investment onshore, which was a great learning experience for the team. It was probably only about $30 million in size, which for the amount of work involved, it probably wasn't of scale, to be honest, I think. And then we have a co-investment vehicle in China, which we invested with a couple of our peers. If you think about all of the funds that we think of as our peers, in some ways we are least like the Australian peers, because of course we're a government funded entity. We've got a time horizon of, you know, we don't have any payouts for at least 20 years. We don't have contributions coming in right now, so profile wise we're very different from the Australian super funds. And in terms of investment style, very, very, very different. So It's interesting because fees are important for all investors, frankly, but the reason for the fee debate in Australia is quite different to the way we look at fees. So for us, fees on the private equity side are an important component simply because we're constantly trying to weigh up, is this the best way and the most efficient from a cost perspective way to access an investment opportunity? Because if we can do it directly in the public markets for a much lower cost and we have control over it from a liquidity perspective, then that's the way we would invest. So for us, private equity, the fees are what they are, but they definitely go into our hurdle. They're definitely an important part of how we compare a public market equivalent versus a private equity vehicle, because it all comes back to the returns, right?
Yeah.